Good evening. Welcome to Money Matters. I'm Charlie Shields of Wells Fargo Advisors. My co-host tonight is Patricia Dunn of Merrill Lynch. Good to see you.
Good to see you
Pat.
again.
Our special guest is Kevin Jameson, Chairman of Dementia Society of America. This is a growing problem, an important problem, and most of us, if we haven't had a problem associated with this ourselves, one of our relatives, it will probably happen down the road. So stick with us. It's going to be an informative show. So, Pat, let me start the show by talking about what I call the three vigilantes. When I'm trying to gauge whether inflation's coming, I look at three different signals. What's the dollar doing? What are long-term bonds doing? And what's gold doing? So I know you're tuned into all this stuff. You're aware of what's happening in all three areas. Do you think there's inflation coming from what you see?
Actually, I do, because after the Trump election, the market took off like crazy. And one of my experiences with 40 years in the business, much like yourself, is that when the market goes up too much too fast, it generally has a petering out.
Sure.
And what could bring the petering out of the rally? And it could very well be that the interest rates have risen too fast. It could also be that the dollar has gotten too strong. And both of these could have a dampening effect on corporate earnings. And yes, a side effect of that could be inflation. So I'm in complete agreement. Why don't you tell us a little bit more about your vigilantes?
Okay, well, I try to look at the three collectively. And in our last show, we talked about the market can go up while the dollar's rallying. But the dollar can't go up forever and have the stock market continuing rallying. So I'm watching the dollar rally as a positive thing for now, as long as it kind of stabilizes and goes back and forth. And if the dollar is rallying because the economy is going to be strong, that's a positive. But then the question is, do we bring the rest of the world with us, and the other currencies going to start competing with ours and all that sort of thing? So that's one factor, is the dollar. And I'd call that a plus to not worry about inflation right this minute, as long as it stabilizes. The long-term bonds tell another story, and what's been happening lately is interest rates are starting to rise, and that can be because of a strengthening economy, or it can be because there's some inflation coming. Now I go to my third vigilante, gold, and I see so far, surprisingly to me, gold has been going down. So right now we got an argument between the long-term bonds and gold. So it's to be continued to see which one caves in. If gold turns around and starts going up, that's a warning sign for inflation. If the long-term bonds have suddenly risen, they stabilize in here. So I'm not giving our viewers and listeners an answer right now about whether inflation's coming back, but that's how I look at things to try to figure out if it will come back.
All right.
All right. Now, another thing that I think is pretty interesting lately is the small caps. And we want to remind our viewers and listeners not to time any market decisions based on what they hear here, because it's taped different times, different places. We're not accountants. We're not attorneys. We're trying to help people make money in the stock market. So I found it interesting how sharp the small cap rally was in the recent past. What's that telling us, or what do you think about that? Will it continue?
I think it possibly could. A rally in the small caps tends to come at a certain point in the economic cycle. What we have had, the Great Recession, they called it, where we had very slow growth for a very long period of time. It tended to have investors stay in bonds or dividend-paying stocks, considered, less risky investments.
Yeah.
And in that environment, growth stocks tend to do quite well. In this environment, it's interesting. The emphasis now seems to be more towards the value stocks, because if the market's going to keep going up, and maybe this rally in the small caps is like a bell ringer, that maybe it's time to switch from the growth-oriented stocks more towards the value stocks.
And another thought is that the questions about the dollar rallying or not rallying and what that does overseas, small cap companies tend to be located in the U.S. and they aren't impacted as much. So if people are confident that there's some steps being taken to grow our economy, but they're not sure who's going to be the ultimate winner of overseas corporations or large U.S. corporations that ship overseas. It's a little kind of a safe play till people figure things out. So
I agree.
It'll be interesting to watch that follow through. Now let's talk a few sectors here. Healthcare seems like before the election, a lot of those stocks got hurt because people were afraid if Clinton got elected, she'd say, go ahead and spend billions trying to develop the cure for cancer or whatever, but then you won't be able to charge very much to get your money back, and so the biotechs and some of the big pharmas went down, and then right after the election, some of them bounced back, and now since then they've been volatile. So what do you make of all that?
Well, I do think that the healthcare stocks are going to continue to be weak.
Okay.
Another sector I think that'll probably be weak will be your utility stocks, maybe your telecoms, because they traditionally do not do well in a rising interest rate environment.
Sure.
So.
Okay. Yeah. Utility stocks and also some other investments. People have been reaching for yield, and so if they're in some high yielding investments that aren't ultra safe, people may be selling those off also. So I think it's a good time to go see your investment advisor and revisit your entire structure, because
Yes.
people that have been reaching for yield could get badly hurt if rates continue to rise, correct?
Absolutely. And where people tend to think of themselves as moderate and think that they're playing it safe because they're a moderate investor, moderate investors get hurt in a rising interest rate environment. They may want to go through with their financial advisor their risk tolerance again to see if they would be more appropriate as either moderately aggressive or even aggressive.
Sure.
Because if their ultimate objective is to grow their money so they have enough money to retire on, you don't want to be caught on the wrong end of the risk scale in a rising interest rate environment.
Good point. And when our viewers and listeners get their next statement after this sharp rise in rates, they may go into shock, but don't panic. Just, maybe make some on the margin adjustments, but don't sell all your bonds just because interest rates have risen. We don't know that they'll continue to rise. They might or they might not.
No, we believe that you always should have a well-diversified portfolio, but you can overweight and underweight different asset classes.
Fair enough. Let's talk about the timely topic of indexes versus, quote, smart money managers. For a long time, the indexes have worked better. And now the conventional wisdom in Barron's and every other publication is, what do you need these money managers for? Just go ahead and buy the indexes. What's your thought?
No, I'm a believer in active management. I have seen over time, you get a good manager and you can get very consistent returns. I would much rather do that than get involved with picking this index and that index, and do I overweight this and underweight that? No, go with a good money manager.
And earlier we were talking about different sectors are bouncing around, and indexes tend, if one sector is going down, indexes can amplify that, because if everyone is selling those healthcare stocks, the indexers have to keep selling, even when it's probably time to start buying and taking advantage. Whereas a money manager can unemotionally take a look at that situation and say, well, they've driven these things down far enough that I'm going to pick out the stocks that are the best and perhaps start outperforming. It usually is cyclical, and for a while the indexes will work, and then for a while the money managers will work.
And I think in the environment we're going into, it's more likely that the money managers will come out ahead.
Okay, good. I don't want to get too much into the politics of who won and who lost in the election, but I do think I'm getting questions from my clients about whether it matters that Trump is picking cabinet people that are a little unconventional, business people. What's your feeling? Does that matter much to the stock market, or are they just looking at what the earnings are of the different companies?
No, I think it does matter, and I think it's very positive for the stock market, because by having business people in key positions in Washington, I think that more assures a pro-growth economy. And we've had everything but business people.
Sure.
So it's like we're finally bringing in a different perspective. And let's see how a different perspective can get things moving, because For the last 30 years, things haven't been moving a whole lot.
So whatever your perspective, give him a chance, right?
Give them a chance.
Terrific. Okay, well, he's been sort of target shooting some companies and, saying that Air Force One shouldn't cost as much as it does and that sort of thing. My own gut feeling is that he's just trying to put a little drama into getting his point across, and that he's really not going to be making phone calls every time he sees a price increase with some corporation. But I don't think it can be healthy if he decides to keep making phone calls every time he reads the Wall Street Journal and sees that he's not happy with some decision a corporation made.
I think there's a certain amount of time on his hands before he walks into the Oval Office, and a lot of that may change in a matter of a few weeks. But we all know government overruns and overspends for so many things. At the end of the day, it is a breath of fresh air that somebody wants to take a serious look at this.
Sure.
And if we can clean things up, there could be more money for other things like Social Security and Medicare. Is it necessarily bad that we pay fair prices for things as opposed to inflated prices?
Sure, and some people would be willing to pay a little more if it meant that their next door neighbor had a job, so we'll see how that all plays out. It's going to be interesting.
Mm-hmm.
So I don't think, for example, in this tariff issue, I don't really think he's going to be imposing 35% tariffs if someone makes him angry overseas, shipping stuff in, and we talked about he's picking some really good cabinet advisors, and I think they'll be trying to steer him clear of doing anything really stupid. So
isolationism hasn't worked in the past, and tariffs is a big way to bring in isolationism. So I think he'll get talked out of that by his advisors.
Good. All right. Well, let's try to help one of our viewers. We have Kelly Robinson of Philadelphia says, what are some drawdown strategies for retirement? How do you tell one of your clients to plan so that they can take money out in some sensible way?
Kelly, that's a very thoughtful question. And truly, in retirement, there are things that we absolutely cannot control. There are things that we can control a little bit. And then there are things that we really can control, like our spending and our asset allocation. As a wealth management advisor, we present 3 different strategies to our clients, depending upon their initial net worth when they come to us. And understand that this is a wealth management issue. This is complex. This is not something you attempt on your own. You should go see a professional. But basically, there are 3 strategies that we use. One is a systematic withdrawal process, where you're taking a certain percentage out of your portfolio every year that you're in retirement. Now, where people get into trouble with this is they take too big of a percentage. We recommend no more than 3 to 4%, because the sequence of returns in the market after you retire, say you retire into a bear market and you take too much out, you can literally run out of money before you run out of years. So systematic withdrawal, but emphasis on low percentage, no more than 3 to 4%. The second approach we call the bucket approach. And in the bucket approach, we go for 3 portfolios. 1 dedicated to consumption during your go-go years of your retirement. The second one is dedicated to an intermediate, or to meet your needs in the slow grow years. And then finally, a third portfolio that is for the long term. And the long term is for the no-go years, or as our guest will be talking about today, the issues of dementia during the no-go years, and or inheritance or philanthropy. The third drawdown method that we use, we refer to as the floor and the upside strategy. Here again, we're using buckets, if you will, but it's how we're investing the buckets. To meet your essential needs, food, shelter, clothing, absolutely what you need in retirement, you use low-risk investments. They could be annuities, they could be certificates of deposit, but something where you're going to get a predetermined cash flow to meet your essential needs. And then you have a second portfolio for your intermediate, and long-term, really. And there you're taking moderate to higher risks, because those will cover your wants and your dreams. So those are the three methods, but as I mentioned before, this is something to be discussed with a wealth management advisor who will keep an eye on you during retirement to make sure that you're sticking to the plan.
Thanks, Pat. That's an excellent response, and I think you've convinced them that they need some help. And I would add, be sure and go 6 months before you're going to retire. Don't say, we'll get around to it, and you go into a 2008, and all of a sudden you weren't ready. So, okay, if you have any questions, please send them in. We're going to show you how to do that right now.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
And now to the special part of our show, Kevin Jameson, Chairman of Dementia Society of America. Thanks so much for being here. From your title, it's obvious what you do, so let's get right into it. Just help us to think about, how do people, as they approach this problem, give us 2 or 3 things that they should think about with their finances and dementia starting to come into their lives.
Well, first of all, thanks for having me here today. It's a real pleasure to be able to speak to you and your audience. I think what a lot of people need to do is think about the same things that they think about when they're planning for retirement. And the real word there is planning.
Okay.
So when it comes to dementia planning or planning for older age, the more you can do ahead of the curve, the better.
Sure.
And this may not mean that you're going to have a form of dementia, but at least, if there's that chance, and there is a growing chance that somebody could have an issue. Today, probably more than 1 in 3 seniors may end up with some form of dementia. So your chances are pretty high as you age. It's not a normal part of aging, but we all should start planning sooner rather than later.
Okay.
All right. Now, you hit the nail on the head when you said forms of dementia. I know it's very broadly defined. Can you help us get our arms around just what is dementia?
Certainly. So dementia is a set of symptoms, really. It's a condition and set of conditions. And it's an umbrella of many different forms of either diseases and specific neurocognitive conditions. Most people would know the word or term Alzheimer's or Alzheimer's disease. That's a very prevalent form of a dementia, but it's one form. Other forms of dementia might be Lewy body dementia, which is closely related to Parkinson's, or frontal temporal dementia, or CTE, which is what some of the football players, soccer players, and others get with the chronic hits to the head. And then another very kind of prevalent form would be vascular dementia, which is very closely related to strokes and other types of cardiac issues. So at the end of the day, there are at least 10 or more leading forms of dementia, including Alzheimer's, and then there are a lot of very rare forms of dementia: Creutzfeldt-Jakob, Wernicke-Korsakoff. Almost every people that live long enough with Down syndrome have some form of dementia towards the end of their lives. Multiple sclerosis, HIV/AIDS, Huntington's disease, etc. So there are a lot of different forms of dementia.
Well, you've convinced me that this is complex, so obviously there's going to have to be several team members to help an individual. Can you talk to us about for, let's say a person is 62 years old right now and they're starting to want to prepare for this if it's needed.
Yes.
Who are some of the people they should be involving in this decision?
Okay, great question, because it is a team approach. Obviously, financial professionals are critical. Those that have experience with estates would be of particular importance. Going along with that would be legal advice, and as well as elder law. So, elder's a good word, and elder law are, two good words together. And that would be people that are experienced in Medicare planning, Medicaid planning, long-term care, and so forth. In addition to that, as we get older, your primary care physician is just kind of one person in the team. Maybe they even lead part of the team medically, but then you also have gerontologists, and you have and a kind of a form of that would be a geriatric care manager, which is more of a social worker, but they're somebody that looks broadly at your situation, and in particular, if you yourself or a family member needs long-term care, either in the home or out of the home, they can help coordinate that kind of care. So you've got both your general practitioners, you've got specialists as you age, and then you kind of have the social worker component who are experienced and licensed to help you kind of coordinate it all.
And even that is complex because, like everything else in life, you've got to have someone you can trust. And so there may be a family member and a social worker combining their efforts together. The family member is the person that you say, if you're lucky enough to have one, if something happens to me, this is the person I want speaking for me and making every decision, right?
Well, yes, you get into the whole area of, having, somebody as a power of attorney, both medical and non-medical powers of attorney, and then you've got people involved in the care, whether it's at home or whether it's in a long-term care facility or care community. And that's another thing that people want to think about is where do they want to live? And they may always want to live at home, but it ends up sometimes that for their own safety and for the safety of others, it may be better to live in a care community where you get 24-hour care from professionals.
Sure.
All right. Now, you hit on a good point with the estate attorneys. And Charlie and I, as wealth management advisors, often get calls from estate attorneys asking us to build protections into the dementia party and their families' portfolios. And we do things like trustee IRAs and lines of credit and what have you. But can you expand upon it for going beyond the protection, which is what we do, and tell us, are there any ways that you can actually finance the dementia care?
Well, people do still have access today to long-term care policies. And long-term care policies, there are hybrid versions and there's straight-up long-term care. And so it really depends on your finances and your capability and your interest as to whether you want to put part of your investment in that type of insurance product.
Right.
But at the end of the day, they can be a contributor to your care. So oftentimes there's, private money that you're going to have to kind of think about, potentially interest, not interest, but investment from insurance products. And then ultimately, if somebody does run out of money, then, potentially there's Medicaid to kind of have that safety net. And that's where elder care attorneys can come in and help understand whether that's going to be possible.
Typically, people will look at a pie chart from some organization and say, oh, I'm okay, I've got enough money the rest of my life. I can imagine there's enormous impact if you get this surprise you weren't planning for with dementia that takes you way beyond anything you ever thought about, right?
Well, so the challenge, or part of the challenge, is first of all, if you have dementia, it's not the end of your story. The good news is that although it's typically progressive, and it typically leads to death because most dementias are fatal, but it still allows you to be a person and live a life. And so at the end of the day, when you're doing your planning, you want to be thinking about how do you want to live your life, and how do you want to spend your assets. And, so even though it may be expensive to have, care in a community, $8,000, $9,000, $10,000 a month, will it allow you to have the kind of lifestyle that you want at the end of your life?
Sure.
And so if it means maybe you go on a trip or 2 or 3,
Yeah.
and we encourage that, because
Yeah.
that's really good for your cognitive health, is to travel and to be social and to be with other people. So if you've got money to put in that direction, do it. That's what we would suggest.
Good.
Now, I hate to be negative, but with the elderly, we have to worry about scams.
Yes.
What do you find amongst dementia victims when it comes to scams?
Yeah, so folks that are living with some form of dementia absolutely are kind of targets for scams and fraud. The FBI, reports that, fraud against seniors is just, an epidemic problem.
Yes.
You can write a check to somebody and then, quite frankly, literally not remember that you wrote that check, even if it was an hour ago. So at the end of the day, having some oversight, whether it be family or a trusted third party, critically important. And you almost have to do it you have to suggest this type of help in a way that is respectful and dignified, in that you're wanting to help and protect the person, not take away their independence.
Okay. In a minute or so here, how do you fit in with helping people? Are you trying to just get the message out? Are you directly involved with helping individual families? What do you do?
So our organization, Dementia Society, takes calls from all over the United States and emails, and we actually provide local support connections. So we find out where they live, we find out what their needs are, and then we provide them with reports and connections to local support services so they can get that local support. So we don't do the support ourselves, but we connect them to local support services.
Are you in the Delaware Valley, or are you throughout
Absolutely.
the country?
We're in the Delaware Valley, but we have a toll-free number across the country, so people can find us on the internet at dementiasociety.org. And we also specialize and fund non-medical therapies like music programs, art programs, dance programs. So we really want people to live life.
That's
and
wonderful.
Dementia shouldn't be, as negative as it is. We want people to understand they can still have a really joyful life, and even with a dementia diagnosis.
And you always hope that there's family that are willing to chip in and share. Sometimes there's 3 different children that are willing to all participate, and sometimes one poor soul gets stuck with all of the duties, and sometimes it seems life isn't fair. But we appreciate you coming in and getting people thinking about this, because it's important you think about it early, and you think about who's that person that you really want to put your confidence in if this helps. And we didn't cover as much ground as we hoped today. We hope that you'll be willing to come back.
Thank you.
All right.
Really appreciate it.
Well, our guest next week is Ryan Clark, founder and CEO of PeopleShare, Inc., and they're going to be helping people find temporary jobs, and if they do good work, it can turn into a permanent job. So we hope you'll come and view next week, because as far as we're concerned, your money matters.